Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know first US dollar plunges 3% in a week to a 4-year low as policy chaos spooks markets. We'll analyse why this policy-driven plunge matters now and how it threatens the dollar's long-standing status as the world's go-to reserve currency. Second, the UN is on the brink of financial collapse as US funding cuts risk creating a geopolitical vacuum for China to fill. We'll explore how this breakdown in multilateral funding could reshape global risk, forcing investors to price in a higher geopolitical risk premium. Third, a $100 billion plan for US firms to rebuild Venezuela's oil sector faces skepticism from giants like ExxonMobil. Today, we'll take a closer look at this test of investor trust and its implications for whether Venezuela's massive oil reserves remain trapped underground. The US dollar just crashed to a 4-year low, shattering expectations for a quiet year on the markets. The currency plummeted 3% in roughly 1 week, a slide that comes after the dollar already lost nearly 10% of its value last year, its worst performance since 2017. So what's behind the freefall? Analysts are pointing to market concerns over what one former Goldman Sachs strategist called the haphazard nature of the Trump administration's policies. Robin Brooks of the Brookings Institution says the dollar's decline is a reflection of markets saying this kind of chaotic back and forth hurts the US more than anyone else. A while back, we flagged how this same policy chaos was bleeding into questions about the Fed itself. Remember, the rare Waller and Bowman descent, Kalshi pricing a high probability that Powell could be out by late summer, and even the Macquarie line that Walsh is not the Fed's guy, he is Trump's guy. Today's move suggests that institutional noise isn't just a headline risk anymore, it's getting discounted into the currency. And this isn't just a vague feeling, there's actually a way to measure this kind of chaos. It's called the Economic Policy Uncertainty Index, or EPU. This index tracks how often major newspapers mention words related to economic uncertainty and policy. When it spikes, it's often a leading indicator of a downturn. You see, this uncertainty forces investors to demand a higher return for holding US assets, something experts call a policy uncertainty premium. As we noted a while back, we've been using prediction markets like Kalshi as a live gauge of that political risk too, right alongside the EPU. If this premium becomes permanent, it could structurally raise the cost for the US to finance its own debt, signaling a loss of the exorbitant privilege the US has long enjoyed. And the fallout is spreading. As investors scramble for safety, the price of gold has doubled over the last year. The dollar's slide is now raising a once unthinkable question. Is its long-standing status as the world's go-to currency under threat? Continuing our last discussion, recall that when Walsh was in the headlines, traders initially pushed the dollar up and gold down on the idea he'd lean hawkish and keep borrowing costs higher. The pendulum has swung. The market is now trading the opposite story. Policy volatility overwhelming any perceived hawkish anchor. This isn't just speculation. The data is starting to show a real shift. For instance, the IMF, which tracks the currency holdings of central banks worldwide, recently reported that the US dollar's share of global reserves has fallen. At the same time, data from the US Treasury shows that foreign governments and institutions are net sellers of US debt. What's striking here is that it suggests the slow trend of de-dollarization might be accelerating. As we discussed a while back, doubts about the Fed's independence can speed that diversification. What looks theoretical then is now showing up in reserve data and flows. For a country like China, which is one of the largest foreign holders of US debt, this trend is particularly important. A sustained move away from the dollar could impact the value of its holdings and influence the renminbi's own path on the global stage. What really brought this to a head, though, is the administration's own stance. While investors worry, US President Donald Trump has openly welcomed the idea of a weaker dollar, stating, "You make a hell of a lot more money with a weaker dollar than you do with a strong dollar." This week, he said he thought the currency was doing great. That stance also brushes up against the hawkish instinct markets once expected from figures like Walsh. Another reason policy signals feel noisier than usual. This isn't just an off-the-cuff remark. It's part of a broader, more aggressive strategy. The administration's use of tariffs, combined with its embrace of a weaker dollar, is seen by many as a weaponization of currency policy. The real danger is that this unilateral action risks provoking retaliation from major trading partners like the EU and China. This could trigger a currency war where countries compete to devalue their own currencies, leading to major instability in global trade and supply chains. And as we've emphasized before, that's the central conflict. Does policy serve the broader economy or a political agenda? Markets are voting with the exchange rate. This puts the White House in direct opposition to investors seeking stability, and the battle lines are being drawn. Major financial institutions like ING are now forecasting the dollar could fall another 4 to 5% this year. While a weaker dollar can make US exports more competitive, the core conflict remains. So, where does this leave us? Well, we're now seeing a strange divergence in the market. Normally, a falling dollar signals a weak economy, which should also mean falling stock prices. But right now, we're seeing the dollar fall while US stocks remain high. Some analysts are calling this the canary in the coal mine. It suggests a durable shift in global growth expectations away from the US. This kind of divergence is usually unsustainable. It means one of two things is likely to happen. Either the dollar is oversold and will rebound, or US stocks are facing a major downside correction. As we said a while back, keep an eye on those prediction market odds and any Fed leadership headlines their real-time tells for whether the policy uncertainty premium is getting baked in. As one analyst warned, if the market is dropping the dollar as a verdict on poor policy, that is a very important signal. We've just been discussing how US policy chaos is roiling the currency markets. Now, let's shift focus to how that same dynamic is playing out in the world of global diplomacy, because the United Nations is on the verge of imminent financial collapse, with a warning that the money could run out by this July. For global markets, this is a major red flag. The accelerating decline in UN funding signals a potential breakdown in multilateral cooperation. When that happens, markets begin to price in what's called a geopolitical risk premium. And just to give you a sense of the scale, according to the International Monetary Fund, or IMF, heightened geopolitical risks can cause stock returns in emerging markets to drop by an average of 2.5 percentage points per month. This UN funding crisis is a key indicator of that growing risk. The crisis stems from member states failing to pay their mandatory fees, leaving a record amount of unpaid contributions. The UN's largest financial contributor, the United States, has dramatically reduced its payments, refusing to contribute to the regular budget in 2025 and offering only a fraction of its expected funding for peacekeeping operations. The US pledge for humanitarian programs dropped from $17 billion in 2022 to just $2 billion. However, if you zoom out, you'll see another layer of strategy at play. The situation presents a fascinating duality. On one side, the US is the UN's largest financial contributor, assessed at 22% of the regular budget, while on the other, China is the second largest at nearly 20%. The US strategic defunding therefore creates a vacuum in international governance. This provides a clear opportunity for China to expand its influence over global standards and development finance. The knock-on effect is that it risks splitting the global economy into two camps, forcing multinational companies to align with either competing US or China-led blocs. This is a major trend for global businesses and investors to watch, but the financial chaos goes deeper. A bizarre internal rule is forcing the organisation into what its own Secretary General calls a double blow. The UN is now legally required to refund unspent money from programs, even if those funds were never paid in the first place. Just this month, the UN was compelled to return $227 million in funds it had never actually collected. As Secretary General Antonio Guterres stated, we cannot execute budgets with uncollected funds, nor return funds we never received. He issued a stark ultimatum to all 193 member states. Either pay your dues in full and on time, or the organization's financial rules must be fundamentally overhauled to prevent collapse. And these aren't just abstract problems. These humanitarian shocks can trigger direct economic ripple effects. What's critical to understand is that the collapse of UN programs in fragile states could lead to unpredictable refugee flows and local instability. This, in turn, disrupts regional labour markets and creates supply chain risks for specific commodities like agricultural products or minerals, potentially leading to upside inflation risks. For example, the World Food Programme has already been forced to pause food distributions in parts of Sudan due to fighting, and in Afghanistan, it has cut assistance to less than 10% of the food insecure population. These are not just tragedies, they are leading indicators of future economic volatility. So the critical question now is whether major contributors, especially the United States, will make significant payments before the deadline. This situation signals a potential degradation of international law's enforceability. For investors, this could increase the risk premium required for long-term foreign direct investment in emerging markets that rely on UN-brokered stability. Essentially, the system that provides a safety net for global investments is showing cracks, and that adds a layer of uncertainty for everyone. Speaking of global power vacuums and competing influence, a massive one has just opened up in Venezuela. Following the dramatic removal of Nicolás Maduro, a $100 billion plan is on the table for US firms to rebuild the country's shattered energy sector. This isn't just any oil field. It's a nation sitting on the world's largest proven reserves, an estimated 303 billion barrels. A while back, we talked about Washington's shift from financial sanctions to physically seizing Venezuelan crude, roughly 50 million barrels, and the stated ambition for a US-directed $100 billion rebuild. The latest development is that this vision is no longer theoretical. It now sits on a formal track after Maduro's removal and a parliamentary green light for a new contract model. When we place this US-led investment framework alongside the current geopolitical landscape, the bigger picture becomes clear. It's emerging just as China's influence in the region is declining. For years, China engaged in checkbook diplomacy, providing massive oil-for-loan deals to Venezuela. But with no new loans issued since 2018, that era is ending. This represents a significant geopolitical shift, potentially redirecting global heavy crude trade flows away from Chinese refiners and toward US Gulf Coast refiners who are well equipped to process Venezuelan oil. As we previously analysed, actions like the tanker seizures pushed countries to explore alternative trading blocks to reduce exposure to US. Policy shocks today. The centre of gravity looks set to swing back toward the Gulf Coast if investment actually materialises. The prize is immense, but the starting point is catastrophic. Under Maduro, Venezuela's GDP collapsed by more than 70%. Oil production, once a mighty 3.5 million barrels a day, cratered to just 860,000. Former symbols of prosperity, the American-style oil camps, now sit looted and abandoned. But it's crucial to manage expectations here. The idea that Venezuelan oil can immediately flood the market and solve global energy price issues is a bit of a myth. The reality is that any production increase will be a slow, gradual process. According to the International Energy Agency, Venezuela's sustainable capacity is extremely limited due to decayed infrastructure. This means the ramp-up will be a lagging indicator of operational success, not an immediate supply shock. So, don't expect a quick fix. Recall, we said those seized cargoes were an unconventional, one-off supply injection. This rebuild is the opposite painstaking capacity restoration that takes years. Here's where it gets interesting though. Maduro's own loyalists, while demanding his release, have just cooperated with the Trump administration to pass a new law. A law designed to bring foreign and local oil companies rushing back in. It's a stunning pivot. What's pivotal is that this new law directly addresses the fears of foreign investors. It dismantles the state monopoly, allowing private companies to have full control over production and sales. Crucially, it also introduces independent arbitration for disputes and sets a cap on royalties. This is a deliberate attempt to prove that the country is now investable. Continuing our last discussion about sovereign asset risk, the chilling effect from expropriations in Caracas, and more recently, direct physical seizures at sea, this framework is Caracas trying to lower the perceived risk premium. This opens the door for a potential gold rush in the decaying heartlands of Lake Maracaibo, where 13,000 wells could be brought back online. But there's another massive hurdle that isn't getting as much attention. The scale of the environmental catastrophe here. Decades of neglect have turned Lake Maracaibo into a toxic soup of crude oil leaking from old underwater pipelines and untreated sewage. Any new partnership will face the world's biggest ESG cleanup. The level of capital spending on environmental remediation will be a leading indicator of whether these companies are committed to modern standards or if they are simply repeating the mistakes of the past. But that's not the whole picture. The real sticking point is the history between Venezuela and the very companies it now needs to court. ExxonMobil's chief executive Darren Woods just went on the record, labelling the nation uninvestable in its current state. His direct warning sent a chill through the market. He reminded the world that his company had its assets seized there not once, but twice, and stated that re-entering a third time would require some pretty significant changes. As we flagged earlier, unpredictable asset grabs, no matter who's doing the grabbing, raise the bar for re-entry. After all, this sentiment perfectly captures the core challenge. The success of this entire $100 billion plan will be a test of whether these new legal reforms can overcome the original sin of prior expropriations. It will set a precedent not just for Venezuela, but for other high-risk, resource-rich nations around the world. The stage is set for a monumental conflict. Venezuela has opened the door for a $100 billion revival, desperately needed by a population where some state pensions are just $2.80 a month. But with industry giants demanding ironclad protections against history repeating itself, the world is now watching to see if the world's largest oil reserves will fuel a historic comeback or remain trapped underground by the ghosts of the past. Ultimately, the path forward is far from certain. The clearest signal to watch will be the flow of foreign direct investment, or FDI. This will be the most direct indicator of whether international companies believe the risks have truly subsided. If capital starts flowing in, it could signal a revaluation of Venezuelan assets and a potential drop in its sovereign risk. If it doesn't, it means the legal changes weren't enough and the oil will likely stay in the ground. And as we noted a while back, keep an eye on risk proxies like maritime insurance and any tit-for-tat seizures. If those pressures fade, the odds of durable investment go up.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.